Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We have a lot of interesting topics to cover in the markets right now. The Federal Reserve Bank has been cutting rates. They just cut rates again, another 25 basis point rate cut. That's 75 basis points worth of rate cuts just in the last couple months. And they've hinted there might be another 25 basis point rate cut coming. He is a former hedge fund manager at well-respected hedge funds, a professional trader for over 20 years. And he just changed jobs. He's now the macro strategist at the Bear Traps Report with our friend Larry McDonald, who just put out this great book for retail investors, When Markets Speak. Craig Shapiro, thank you for joining me again.
Thanks for having me back, Jason. Appreciate it.
So, Craig, we're recording this interview on Thursday, November 14th, 2024. The 10-year US Treasury yield, it's rallied back up to 4.4% on the yields. I want to get your thoughts first on the Federal Reserve Bank rate cuts rather than rates starting to rally first. Are the Federal Reserve Bank rate cuts in past market cycles, are they normally bullish or bearish in your opinion for the stock market indexes?
Yeah, I mean, the Fed typically cuts interest rates when it is looking to stimulate demand, when it's looking to improve labor market momentum, when it is concerned that inflation is running below target of 2%. And so, historically, the impact of rate cuts on the stock market really depends on what kind of economy the Fed is cutting rates into. And so there's been examples in the past where the Fed cuts rates to try to kind of tinker with the economy. Inflation has been coming down. Don't need that level of policy restrictiveness anymore, and the labor market showing minor signs of deceleration. And so a little bit of interest rate cut momentum can help stabilize the economy and lead to a more prolonged expansion. That's typically constructive for equity markets. And then there are times when the Fed is forced into cutting interest rates when growth is slowing more materially and inflation is coming down more significantly, or there's financial market consternation. You could think about in 2008 cutting cycle, or in the 2001 cutting cycle, and those led to periods of equity market weakness because the Fed was late to the cutting. The growth got worse before it got better. Policy remained restrictive because even if rates are coming down, if inflation is falling faster, real rates are rising and providing a headwind to the economy. And so that's typically a negative environment for equities at the onset until the Fed does a material amount of cutting and the economy starts to positively react. And so the question this time around really stems with, has the Fed been cutting into an economy that needs it, or is it cutting into an economy that doesn't need it? And so back in the summer, in July, many folks thought the Fed should have cut interest rates in July. They decided to pass on that. And what we saw in subsequent 6 to 8 weeks was an economy that started to show some signs of deceleration and weakness in the labor market, decelerating, not significantly, but certainly at a much more protracted pace. Initial jobless claims were rising, continuing jobs claims were rising, and the payroll numbers for the month of July that came out early August were a large concern, a big drop in hiring. And so that really spooked the Fed into what became a surprise 50 basis point rate cut in the middle of September. And so what we've seen, though, since then is it looks as though the data from the month of July and the month of August that had the Fed concerned really was more one-time, short-term, not representative of the entirety of the economy. Maybe had some election uncertainty in it. That was a time when Biden stepped out, Harris stepped in. She's making some inroads. Her polling data is going up, and so maybe there was some concern about her winning the election and what that might mean for the economy for the next 4 years. And so that seemed to plague the economy here. Fed cuts rates. Subsequent to them cutting rates 50 basis points in September, the data has stabilized and has started to improve. Obviously, subsequent to that, Trump wins the election with a Republican sweep, and so animal spirits are starting to get more excited about that. And then lastly, on inflation had been showing some reasonable signs of deceleration through the second quarter of this year, but it seems as though that has come to an end as well. Last couple of months have shown more significant sequential acceleration of inflation prints that would not be commensurate with returning inflation back down to target of 2%. And so basically what we've seen since the Fed cut rates 50 basis points in September is the growth outlook for the economy has improved. Part of that is Trump, as I mentioned. The inflation outlook looks a little bit worse, meaning prices look like they're potentially moving higher. Some of that is on back of just higher asset prices leading into better spending. And then lastly, on the labor market, it seems like it's not as slowing as rapidly as initially feared. And so what you have is an economy that maybe doesn't need the level of interest rate accommodation that the Fed has shown. And so last week, the Fed cut again, another 25 basis points, and the reaction, although so far has been favorable to equities. What is important to note is that despite the Fed cutting now 75 basis points over the course of the last 2 months, the long end, 10-year, 30-year yields have moved higher. Mortgage rates have moved higher. And so question is really, was that expected when the Fed decided to cut rates over the course of the last couple of months? Or is this the bond market reacting to something else, whether it's stronger growth, higher inflation, concerns about the Trump agenda being pro-growth, pro-inflation, with the discussion about tariffs and about immigration reform and tax cuts and the like. So that's what we're dealing with right now. It's the Fed has cut rates 75 basis points in order to help stimulate the job market, but the bond market is saying perhaps we don't need that level of accommodation. So that's kind of where things stand right now at the middle of November.
Excellent summary, Craig. And Craig, you're answering my questions before I even asked them. I had those questions about the mortgage rates and rising interest rates on the 10-year US Treasury yield. You already answered them. So I want to get your thoughts then on the other central banks that started the rate cutting cycle before the Fed. Do you think that liquidity from the other central banks starting to cut rates, do you think that that's responsible for the stock market starting to rally before the election? Or do you think that the market was starting to price in a Trump victory?
I think you could really see the most recent breakout in stocks being driven more by the expectation of Trump winning, and then the increased probability that him winning would lead to control of the House and Senate. And so as the odds of him winning started to go up towards the end of October and the first week of November, that's really when we started to see this breakout in equities. Again, another breakout. I mean, clearly, equities have been strong for the most part all year. Earnings have come in, fine. Probably not as good as people had expected, but they've largely been fine. And with the move down first in interest rates from the first half of first quarter this year, kind of through September, that had led to multiple expansion for equities, and so equities have been doing fine. But this most recent move and acceleration, really, I think, has been driven by the Republican sweep and the knowledge that we were not going to get a regime where Harris was at the helm, where tax cuts were going to be eliminated and taxes were going to be going up next year. And so I think stocks have really positively reacted to that. And so now the question is, can they continue this rise in the face of a bond market that has increasingly been selling off, right? And so we're in an environment where yields now have moved aggressively from the lows in September. 10-year yields are back to 4.44%. They've moved 75, 80 basis points over the course of the last 2 months. And so as these inflation prints come in a little bit higher than expected, this week we had the CPI, PPI, which came in a little bit firm. And the Fed, Powell is out there today. It's got to talking about his expectations for core PCE at the end of this month, coming in at higher than expected reading of 0.3% month on month. which would annualize to 3.6%, which is certainly above the Fed's target of 2%. So the bond market is reacting to higher inflation. The bond market's starting to react to the expectation for Trump delivering a tariff regime that's potentially going to be inflationary at the onset, and a tax cutting plan that may expand the deficit. And so so far equities haven't minded the rise in rates, but international stocks have started to slip on back of higher yields and on back of a stronger dollar that we've seen more recently, which has been driven by both the tech regime and the better growth and inflation outlooks in the U.S. So I'm a little bit more sanguine about the outlook here for equities. Things have come quite far, quite fast. But I think we're going to see some of the negative stuff about the Trump agenda on trade come before we see the positive benefits to his agenda dealing with deregulation, tax cuts, and trying to stimulate real GDP growth. So we're in a little bit of a transition period here. And I think the markets may be at risk as we kind of head through the end of the year and into the early part of next year.
And those budget deficits, unless the Department of Government Efficiency starts to really cut into the government spending, I mean, I think those budget deficits will start to increase as Trump gets into the White House in the first 6 to 12, 18 months, because he just has a track record of doing variations of supply side economics. Now, maybe the Department of Government Efficiency, maybe it actually does work. In theory, maybe they're actually able to cut some stuff. We'll see. It's still too early. I don't even think they have a website yet.
Well, they have a Twitter account, which is good. But look, this is really a commission, right? This is not a department of the government of the cabinet. It's some folks who are going to try to take the red pen and try to find waste and fraud and lower government spending. I think the issue that this commission is going to find is that the big buckets of spending for the deficit are very difficult to touch. Obviously, entitlements, Social Security, healthcare. I think it would be great if, and military, right? So on healthcare and on Social Security, I mean, entitlement cuts have been the third rail of politics for a very long time, and so while it's possible that I'm sure there's inefficiency, and I'm sure there's some fraud, and I'm sure there's but it is harder to go after that spending without legislative help. As far as defense is concerned, surely similarly, there is waste and excess in the defense budget, but Trump is being is kind of seen as favorable to the military and strong on the military, and so kind of coming out with this, hey, we're going to cut the military budget by X%. I'm not sure how well that's going to fly
with his base, yeah. Yeah, I mean,
and then so basically the other things you have are, let's hold interest expense to the side for one moment, because that's obviously another huge driver. But the rest of the stuff that I think people believe maybe is easy to cut, other departments, Trump wants to cut the Department of Education, and then these other departments, they just don't move the needle, right? They're just not big enough to matter.
It's almost impossible to fully cut agencies. I mean, like, look at the Federal Aviation Administration. I mean, a lot of the government employees are shifting jobs over to other government agencies. They get priority hiring. I mean, you have these government employee unions. It's not easy to just cut these government agencies. I mean, there's lawsuits. The government employees end up at other agencies. When the Democrats, 4 to 8 years from now, or however, whenever the next election cycle, they could regain control of Congress or the White House, and then they'll reinstitute all the government agencies and rehire the government employees.
Yeah, look, I mean, I think obviously, Trump has a big agenda and big ideas, and through the campaign, and clearly so far he's hired a cabinet that is unconventional and away from the traditional kind of deep state types that certainly were part of his first administration and have been part of Democratic administrations for quite some time. So there is I think there's a belief that he could be successful in cutting some of the fat and getting through some of the red tape. But we'll see, because if he is going to go down a path of deficit reduction, there will be adverse impacts on growth in the U.S. economy. And so is that something he's willing to tolerate? Is he willing to tolerate a growth slowdown, potentially an asset price correction early in his administration in order to achieve some of these lofty goals? This is not somebody who in his first term was desirous of seeing any growth slowdown or any market hiccup. So he would have to tolerate something that's different than what he did in the first 4 years. So again, I think there's a lot of expectations about this, that Trump being changed, a changed person with a different agenda now, being a one-term left president, hopefully. But look, I think it's a little bit too early to tell, and I don't think that the DOGE committee is going to be very successful early on with actually cutting the deficit. It's going to take some time. It's going to take some real work, and it's going to take some tolerance by the administration to allow for some lower growth to take place in order to be successful.
Yeah, I agree. And there's a reason why that the Department of Government Efficiency is not going to be connected to the government. So Elon Musk can still run his businesses. So he doesn't, as a government employee, if it was a government agency, I think he would have to sell into a blind trust or something like that. He couldn't run any of his companies.
That's correct.
Yeah. So, I mean, I guess like it's kind of like it's going to be like a pseudo agency or something like that. But I mean, if they figure out how to get rid of just some of the stuff that we're seeing on the Festivus report from Rand Paul, I mean, that would be a good start. Unfortunately, there's a lot of people that come to Washington, D.C. And, a lot of the stuff there, I saw like there was something about learning butcher's language for Paris for $30,000. I mean, it sounds like someone just got a free vacation to Paris for the $30,000 or $40,000, and they figured out how to write it off as like a government research grant or science research report or something.
Yeah, look, I mean, it's clear that there's fraud, there's waste, there's overbidding, there's a lot of things that could be done and hopefully will be done. Look, the level of spending by the government is excessive, and it needs to be addressed. And it's been very difficult for members of Congress to agree on budget reduction on both sides of the aisle. And so maybe a commission tasked to try to make some real cuts here will be a catalyst to pushing that agenda through. But don't forget, if Trump's going to move through with the tax cuts being extended, then he's got to come up with even more spending cuts. Now, part of that will be addressed with tariffs going higher. Part of that may be addressed with lower interest rates over time, assuming he can convince the Fed to keep cutting interest rates. Although, as we discussed, just because you cut short-term interest rates doesn't necessarily mean that overall cost of borrowing for the U.S. government is going to materially decline, as we've seen kind of this backup in yields for the long end of the curve, where the Fed, where the Treasury does issue and has a lot of debt out 5, 10, 30, 20 years out into the future. So just because you cut rates doesn't mean that the bond market out there is going to be receptive to that. And if somehow, or the Fed is then ultimately forced to buy those securities in order to prevent yields from going materially higher, well, that's going to be inflationary because the dollar is going to get hit very hard. Commodities are going to move back higher. Oil would move back higher. And so there's a bit of a tough square to circle there on interest cuts helping to reduce the deficit.
Yeah, also, despite the Federal Reserve Bank cutting the interest rates, and it looks like there might be another 25 basis point rate cut coming maybe in December, potentially. So you already have 75 basis points, like you said. The 30-year mortgage has also started to spike. So briefly, it dropped down and people did refinancing, and then it started to spike again. So that's kind of counterintuitive compared to the Fed policy, too.
Yeah, look, I mean, historically, there's been a positive sloping yield curve, right? Where short rates on the short end of the curve are lower than rates on the long end of the curve. And, as borrowers or investors looking for additional compensation to lend money to the government or to individuals for longer periods of time. And so a positively sloping yield curve makes sense. We've been in an environment now for the last several years where we've had an inverted yield curve, where short-term rates have been higher than long-term rates in the Treasury market. And so it's kind of created some distortions and dysfunction about what normally is the case. And so what we're seeing now is a re-steepening of the yield curve where short-term rates are moving back lower again, but borrowers, whether it's individuals or corporates that have to borrow, beyond 5 years or so, and mortgages out in 30 years are paying or being forced to pay even higher rates as in bond investors are looking for higher compensation to lend money to people in what looks like a higher growth, higher inflation environment, right? And bond investors' biggest risk is that they'll be paid back in deflated currency because inflation runs hotter than expected. And so if they're worried about inflation moving up in the future, they're going to command higher rates of interest on their lending. And so that's a bit of the environment that we've been seeing over the course of the last 4 to 6 weeks with the Trump momentum and with the Fed cutting rates is that inflation looks like it's not going back down to 2%. It's likely going to be higher. The Fed is acknowledging a bumpy return to 2%, but even now is thinking, maybe their policy isn't as restrictive as they thought. Maybe the neutral rate is higher than they originally thought. And so the bond market is reacting to that, and the mortgage market takes its cue from the Treasury market. And so as long end yields and 30-year yields now are 4.59%, mortgage rates have blown back out again to above 7% for 30-year mortgages. So it's putting a damper on the housing market momentum. And I suspect that's not what the Fed intended when they started this cutting cycle 6 weeks ago.
Do you think foreign managed money, so flight capital, either in Europe or Asia, do you think that a lot of that managed money, rather than maybe going into US Treasuries for the yield, the juicy yields and the higher, stronger dollar relative to other currencies and the better yields in the US Treasury market compared to other foreign bonds, do you think it's starting to go into the US stock market the last 6 to 9 months instead?
For sure. I think there's certainly been foreign ownership in U.S. equities has really been explosive over the course of the last couple of years. I mean, U.S. outperformance versus emerging market or European indices has been, it's been incredible, right? The U.S. has the biggest, best tech companies with where most of the AI is taking place. It has the highest growth outlook. It has big fiscal deficits, which you don't see in Europe. It's clearly doing better than China. So yeah, we've seen foreign investors have been plowing money into U.S. equities for quite some time. Some of that money is likely come out of their allocations to U.S. fixed income. And so, look, I think the question from here is, will foreign investors continue to put money into the U.S. or, as the dollar continues to appreciate, do foreign governments start to slow that pace of devaluation down? Do they start to sell some of their holdings of U.S. Treasuries or U.S. assets in order to prevent their currencies from moving materially lower in a Trump tariff regime? And these are the things that I think the market is starting to wrestle with and think about because tariffs are disruptive, right? I mean, that's, for sure they're coming. We don't know the magnitude. We don't know how quickly. We don't know exactly on who or not. But if there's anything,
it depends how they're used. Because if you speak to the Trump people, like Jim Rickards is doing interviews, and the Trump people have said in the past, like the people on business television, Danielle DiMartino Booth and others, they've said that the tariffs are just to renegotiate trade deals. So, for example, then the Chinese manufacturers, they'll have to move some factories here to the U.S. to get around the tariffs. So then they'll get an exemption from the tariffs. So I think the U.S. has used this in the past, to get Japanese auto manufacturers like Toyota and Honda and stuff to build factories here in the United States to hire American workers. So if you buy a German car or a Japanese car, it's actually made in Tennessee or South Carolina.
Yeah, look, we'll see. I mean, I think the average tariff increase during the Trump administration in China, in 2016 through 2020 was a mid-teens percent tariff, and the RMB devalued in order to offset that by a similar amount. So there really wasn't much in the way of inflation specifically associated with that, because the Chinese manufacturers at home kind of ate that incremental cost. But what we saw from that tariff regime was we really didn't get any manufacturing from China. We didn't really get a ton of that increased investment in the U.S. from foreigners. And I don't know how receptive Trump will be this time. He may want to see more out of these allies and trading partners than last time, because last time it didn't really accomplish the desired outcome, which was bring back American jobs, reshore manufacturing, and have these companies make more stuff here. It really was just a tariffs up, brought in revenues, dollar appreciated. and foreign companies bore most of the brunt of the of the tariffs, as opposed to seeing a massive pickup in inflation in the U.S. at least up until COVID.
So now that Trump has won the election, which sectors or industries do you think will benefit from Trump being in the White House?
So look, I think there's a view about Trump and what that means on from the deregulation point of view and from a taxes point of view. I think those are the two big things. So there's been a shift in kind of market leadership over the course of the last few weeks and month. Here for the last few weeks, so kind of some of the out of big technology into small caps, which typically would benefit in an environment of lower regulation and tax cuts. So there's been some of that outperformance versus big tech. I mean, think about big tech. I mean, big tech is already, you know, paying low taxes because of overseas earnings, is already not regulated and likely to be increasingly regulated. So I could see, over a multi-year period, some of the capital shifting out of big technology into smaller or medium cap companies. I think, one of the sectors that I'm concerned about under the Trump administration is healthcare and big pharma. It looks like RFK Jr. is going to be put in there as the head of the HHS, and he is certainly not a fan of big pharma. And so I'm concerned about profitability across big pharma.
So good for customers. What we're going to get generic drugs. You and me are going to be, and our family members and friends are going to be able to buy generic drugs, but that's bad for profits for big pharma then.
Yeah, that's the that's it. That's for sure. As far as retail is concerned, similarly, right? They're going to be paying higher costs, tariffs, high crimp margins. So concerned about that. I think domestic energy is seen as an area that's likely to benefit under Trump. I mean, he wants to see kind of 3 million barrels a day of increased energy production over the course of his term. So we might see oil service stocks likely do better as CapEx goes into the oil service space. Domestic infrastructure, domestic industrials on a reshoring campaign, I think is going to be a place to watch. So that's another sector that should benefit. So yeah, those are the likely beneficiaries, I think, and some of the areas that had been seen as Harris victories, beneficiaries like cannabis or like solar, or some of those sectors, I think have certainly started to suffer again under the prospects of Trump winning.
Well, I mean, Elon Musk is there with, I think he has some solar exposure too with Tesla. So I'm not quite sure how that's going to benefit Tesla for their electric vehicles. But I agree with the energy component there. I think like there's going to be more natural gas drilling. I think pipelines might be easier to get approved. I'm looking 4 years from now. I think the liquefied natural gas exports, Trump may offer like discounted loans or something. I think the U.S. could turn into by far the number one liquefied natural gas export because we have such cheap natural gas. If we set up the pipelines, build the facilities, we could have a lot of liquefied natural gas to export to other countries at a big profit.
Yeah, that's a good point. I mean, LNG seems like it's going to be something that Europe's going to be forced to buy more. Japan's likely to buy more as these countries are dealing with Trump's tariff regime. So yeah, I think I agree with you both. That sector seems like a place for profits, let's say.
Well, as a libertarian, I'm not in favor of this, but I think like if the prosecutors and the government, the police and the district attorneys, the prosecutors adhere to the rule of law, I think they're going to put more criminals, people who are like, doing armed robbery and stuff like that into prison that we're getting out. So I think the prison stocks will probably benefit from that too. But, I'm not in favor of that. I'm just saying it's probably going to happen, that it looks like the voting trends, even in the Democrat cities, Craig, where they voted for Kamala Harris, like at the national level, at the local level, it looks like they voted for tough on crime prosecutors that were Democrats or Republicans. So the voting trends changed there. So I think like there's going to be a lot more people that were committing felonies that are not going to get out of prison or get out of jail free or get like a drastically reduced sentence. There's going to be people that commit felonies that are going to be in prison for a long time.
Yeah. Yeah, that's not Geo has been a big outperformer. That's that private prison company. It's done incredibly well. But yeah, look, I mean, a lot of these things are small ways to play. I think the bigger thing that people need to keep in mind is, broadly speaking, how will tariffs impact inflation? How will immigration reform impact inflation? And how will the Fed react to a potentially higher inflationary regime? Will they be forced to raise rates in order to address that? And so I think there's a lot of hope about what Trump can deliver, but often the hope kind of comes too far, too fast, too quickly, and then we set in for some disappointment and some reality. And then ultimately, if he delivers, then we could be on for better things, to end 25 and go through 26. But I think first things first, we kind of need to get through some of this initial period of maybe overvaluation, some concern about tariffs, and some of the negative parts of that kind of regime before we get to the positive parts.
And if the government's worried about inflation, I mean, cutting interest rates this quickly, not a good thing. So do you think then that this maybe has more to do with interest payments on the national debt? I mean, there's rumors that Janet Yellen was pressuring Jerome Powell to start cutting rates because she was worried that about U.S. government funding. And there's not a lot of demand for U.S. Treasuries, especially from the normal buyers the last couple decades for Japan and China.
Yeah, look, I mean, I know that there's, some speculation about that for sure. I don't think the Fed is specifically trying to lower interest rates to help finance the US government. But I do think they do and say things at times in order to, prevent rates from moving higher. So yeah, look, I think they look at an economy at the economy and say inflation has come down materially from 6, 7, 8% to 2.5, 3, 3.5%. It's come down a long way. It seems like it's continuing to grind lower. The labor market has gone from overheating and incredibly tight to way more imbalance. And so they say our policy rate is restrictive, and so we can bring the rate start bringing the rate down in order to kind of address that. And because if we're not bringing the rate down and inflation is falling, then real rates are rising, and that's providing more headwind to the economy. So I think that was the genesis of this. I think the issue that they're facing is they don't exactly know how restrictive their policy is currently. They've been surprised by how strong the economy has handled higher interest rates. They forgot to look at how many mortgage holders have locked in low-cost borrowings for long periods of time during COVID. Many corporates similarly were able to lock in low-cost borrowings. And so the private economy was not as susceptible to the pickup in interest rates this time versus in prior cycles. And so they kind of missed that. And so now the question is the neutral rate higher than they realize? And it seems like over the course of the last couple of weeks, more and more Fed members have kind of been talking about a pickup in the neutral rate and the unlikely case that rates are going to fall back down to, to 2% or lower again. So it seems like that, the Fed is cutting, but the pace of cuts is likely to slow. And the ultimate destination of cuts is likely not going to be as low as people had originally thought. And we're more likely to settle out in an environment of 3.5 to 4% interest rates as opposed to something that is 2.5 to 3.5%.
Okay, so basically, what if I could summarize what you just said? You think that after this next rate cut or the next 25 basis point rate cut in the next couple of months, that the Fed will start to slow down the pace of the rate cuts, and they will sit back and watch what happens then to the real economy and the stock market and the inflation, the CPI numbers each month then?
I think so. And I think there's actually a growing chance that they may actually skip the December meeting. I mean, right now, the odds after Powell spoke today, the odds for the December rate cut have come down already from, I think they were about 85 or so percent before Powell spoke, and now they're down to about 60%. And I think, look at the data over the course of the next couple of weeks. We have retail sales tomorrow, and then we get the employment figures in the first week of December. If those numbers come in well, and the initial jobless claim numbers we get every week continue to come in lower than expected, I think we're going to see the odds of a December rate cut continue to grind lower. And may, turn into a situation where the Fed winds up not cutting rates in December and kind of puts themselves on on a pause track, or certainly a skip track, right, where they skip December, and depending on the data, maybe they go in January. And if data stays good, they skip again. Maybe they cut in March. So yeah, I think we're getting closer to that point. And when the Fed talks about slowing down, it's right now they went from 50 to 25, and if they go next, let's say they do cut next meeting another 25, and then they skip January and they go in March, that's cutting every other meeting. Maybe they cut every 3 meetings, every 4 meetings. So that's how they think about it. But really, it's about the destination of getting back to neutral and how quickly do they want to get there. And Powell said today that they are in no rush to bring down interest rates rapidly at this point. And he said the economy really is not showing any reason to do that. I think his quote today was, the economy not signaling a need for Fed to hurry rate cuts. And so that's his way of telling you, we're just going to watch the data. We may not cut, and we're certainly, it seems like we're not going to be cutting as aggressively as maybe we thought a few months ago, because the economy is doing much better than we thought. And now that we have Trump and the Republican agenda coming in, even though they're not ready to kind of move monetary policy based on an expectation of what Trump's policies are going to be, they do know that what his policy agenda will could look like. And as we push through next year, a pro-growth, pro-inflation, pro-tariff agenda is going to likely be one that the Fed is not going to be stimulating into. So we could be in a situation where the Fed is on a long pause, as soon as the early part of next year.
Well, that assumes that regional banks or insurance companies or the commercial real estate bubble doesn't break, because I know your boss or business partner, Larry McDonald, at the Bear Traps Report, I know in his book, he's been warning about that for a while, that the insurance companies, the commercial real estate problems, they are way worse than a lot of the regional banks, and the insurance companies and the pension funds are claiming right now they have not written off the losses. So we haven't seen the worst of the commercial real estate crisis. If the mortgage rates continue at a high rate, I don't see them being able to, these entities like the banks and the insurance companies, the pension funds, being able to refinance their mortgage at a lower rate to kind of buy themselves some time, and they're not getting the cash flows from the rent. So I see this as a problem. I don't know on the timing of this, though.
Yeah, look, I think these, banks just want time, right? Everyone wants more time to extend and pretend, more time to refinance loans, more time to wait for the commercial real estate market to bounce. And, look, I think it's going to take a long time for some of that stuff, and some of that stuff will never bounce. And so, we're not out of the woods yet for sure. And the more that the long end pushes higher, I mean, if you think back to the first quarter of 2023, clearly the issue for some of the regional banks was that the pace of a quick pickup in long end bonds. And so those held to maturity losses started to become aggressive again. And with high Fed funds costs, that was high borrowing deposit rates for these banks. And so their cost of funding was high, and they were losing money on their held to maturity portfolios. They were seeing margin squeeze. And so regional banks came under some pressure. And that's what the Fed had to create the, BTFP program, which goes away in 5 months. And so as that program goes away again, some of these regional banks are going to be looking for liquidity again. So yeah, we're not out of the woods on a regional bank issue, on a commercial real estate issue, which is regional banks are the ones who hold a lot of that paper. So, the Trump administration and the Fed have a lot to deal with as we head into next year. And I don't think it's just going to be smooth sailing.
Yeah, and especially with the yields starting to spike again on the treasury bonds, that means the older US Treasury bonds at like Silicon Valley Bank, that they got the depositor capital and they were buying US Treasury bonds at lower yields. When the yields go up, there's the older bonds have enormous bond losses too. So there's losses on commercial real estate mortgages, commercial real estate mortgage-backed securities. There's small business loan losses, and there's even losses now in these older US Treasury bonds too, because the rates are starting to rally. They're not staying low.
That's correct. Yeah, that's right.
Well, I want to get your thoughts on Bitcoin, because the Bitcoin price, it's rallied enormously. I was just looking at a chart while you were talking. The Bitcoin price got as low as, I think, $54,000 on August 5th. So only a few months ago. And here we are, it touched $90,000 in the last couple of days. Do you think that this is solely Trump, or do you think that something else is occurring why there's such an enormous rally in the Bitcoin price?
Look, I think that clearly a lot of this has to do with a shift in political power, right? You're going from animosity in regulation to the crypto and Bitcoin industry to acceptance and promotion, right? I mean, Trump is become the Bitcoin president, and he spoke at the Bitcoin conference in Nashville. He has advisors on his team who are pro crypto, who are pro Bitcoin, and sees Bitcoin as a potential part of the solution for America, for lack of a better word, kind of going forward. So clearly, the industry has kind of moved through being vilified for a long time to now being accepted. And so I think now you're seeing kind of the Band-Aid being ripped off, and some folks and some institutions who maybe were holding off to see if Harris would continue, or to see if someone like Gary Gensler was going to continue at the SEC, now are very comfortable that they won't be there. And so for one, that's led to kind of a re-rating of the crypto industry and of Bitcoin specifically, as similar with other asset classes that have rallied on Trump and on the economy. I mean, as inflation is finding difficulty getting back to 2%, and investors are desirous of store of value assets, Bitcoin becomes a home for that capital. Obviously, you see that with gold as well, which has done incredibly well up until let's say the last couple of weeks. So look, I think Bitcoin is and should be part of every investor's toolkit and portfolio, and the degree with which you own it should be, commensurate with your tolerance for risk. It's clearly a volatile asset. But I'm a Bitcoiner. I'm a Bitcoin maximalist. I don't deal with these other crypto currencies, but Bitcoin's a store of value asset with a fixed supply, where the increase in price has no ability to dictate the future supply growth algorithm. So it's uniquely able to become that store of value asset. And so as it gets more acceptance, as it gets more favorable regulatory and trading environment in America, I think it's likely to continue growing its share of the overall investable store of value universe. I mean, think about how many hundreds of trillions of dollars there are in real estate wealth, or I know gold's a 17-18 trillion dollar market. Obviously, sovereign bonds are often seen as a store of wealth, and that's a couple $100 trillion asset. So Bitcoin's still sub $2 trillion asset. There's significant room here for this to grow over time. I suspect we're going to be a lot higher in the Bitcoin price over the course of the next year. But after a big move like this, seeing it digest some of those gains is possible, particularly if interest rates rise and the Fed is kind of forced into a little bit more of or a less aggressive easing bias. And if equities start to get concerned about a tariff regime coming through, Bitcoin's likely to suffer some alongside that. But I'd be using that opportunity to accumulate more.
So a correction and consolidation phase similar to gold, because I know a lot of gold bugs right now are panicking with how much the gold price is down. But I mean, the gold price had rallied enormously since October of 2023. It was up a lot. I mean, I think it was $1,800, and then it hit $2,700. That's a pretty big rally in about a year. So it was overdue for a correction and consolidation phase.
Yeah, and I mean, if you look back to the 2016 election, post that period, gold also suffered, for about 4 to 6 weeks, and had a 10 to 15% drawdown when Trump was elected the first time. I mean, Trump, a pro-growth agenda, even if it's inflationary, it hasn't always been a great environment for the gold price. And so I think some of the outperformance and just some of the digestion of that reality, I think is what's hitting the gold price now. But gold also is being reinserted in the global monetary order as more countries are using it as a store of value asset. More countries are concerned about the growing U.S. deficits. They're concerned about the U.S. sanction policies. And so they are shifting away from holdings of U.S. Treasuries into gold. And I expect that trend to continue over time, certainly for countries like China and for Russia and for Saudi Arabia and the UAE. So I think gold is also, going to have a market cap continuation, acceleration over the course of the next couple of years as it becomes bigger and more important in settling excess trade balances. So I'm a gold bull as well. I just think Bitcoin's probably a faster horse in this race, but I'm inclined to like them both.
Yeah, so you own both. I mean, I own both for a while now, so it makes sense to have some type of diversification for kind of outside the normal asset classes of stocks, bonds, and real estate for commodities exposure, gold, precious metals, and some Bitcoin.
Yep.
I want to ask you in terms of like sectors or industries right now, which sectors or industries maybe that you're looking at as a contrarian you think could they're hated right now, they're cheap, you think could be set up for rally, maybe kind of because Larry, who you work with now, Larry McDonald, he was very bullish on uranium along with me the last 3 to 5 years. We were early on that a little bit. Uranium like 2018, 2019, but by 2020, uranium had bottomed. 2021, uranium bull market looked like it had finally started again with demand for nuclear power, with China and India starting to build a lot more nuclear power plants and some of the other stuff involved in the market there, not just with new nuclear power plants, but also like restrictions on importing Russian enriched uranium and other stuff. Do you see any type of commodity similar setup to uranium where right now it's cheap, it's hated, it's really out of favor, and over the next like year or two, maybe it could re-rate and start to get a big bull market or rally similar to uranium?
Um, Look, I think one of the things just to stay with uranium for the moment. I mean, clearly that it's been a kind of known bull thesis for a bit, and there's been a lot of folks who have kind of have gone up for the ride. But more recently, at least over the course of the last 6 to 9 months, it's really done nothing heroic. And so we're still constructive there. There's nuclear as a solution for the U.S. power grid, we think is still coming. We think that even guys like Elon Musk are supportive of nuclear. We see kind of these big tech and AI companies who are looking to build small modular nuclear reactors at their facilities, and so I think there's still likely room to go in the uranium story, and as it has corrected, we're still constructive there. Oil field services is another area which has been beaten down, has really struggled, in light of kind of weaker than expected oil price momentum as OPEC has been overproducing. But look, we think the Trump agenda is going to be pro drilling, pro energy capex, and trying to continue to grow energy productivity in the U.S. And so companies like Weatherford and companies like Schlumberger, which have been bombed out, seem like they are interesting ideas as we head into next year. Palladium is another area that we've been doing a lot of work on and have gotten constructive on. I mean, the Palladium story is one where electric vehicles taking market share from gasoline and catalytic converters has been negative for Palladium demand. But that story is very well known. It's been a big impediment to demand growth over the course of the last couple of years as EVs, particularly in China, have exploded. But now we're finally starting to see some production come offline in areas in South Africa, and we know that Russia is a big palladium producer, and so as sanctions continue to exist, it's going to be harder to get that material into where it's needed. And so palladium is another area that we like. So look, I think on the hard asset side, a Trump agenda that is looking to protect American jobs and trade and kind of rejiggering the global trade environment, reshoring in the U.S. and bringing jobs back, we think is going to be inflationary at the onset, not just because of tariffs, but because as companies are building the capex in the U.S., they're going to need materials and they're going to have, so we think the hard asset story in a Republican sweep regime under Trump looks very good for 2025, 2026. Whereas, look, I think there's plenty of capital that's been in the big tech trade, that's been in the AI trade. But to us, we're starting to see some signs of exhaustion there, and the likelihood as those industries are going to be regulated more and they're going to be seen as more strategic chips for sure. We think that typically means lower multiples, lower margins, more regulation, and so we could kind of see over the course of the next, let's say, 6 to 18 months, how capital will rotate out of some of that big tech stuff and will need to find a home. And just, little, given how big these companies are, these big tech companies are, small moves in their market cap can lead to big moves in these other industries, these beaten down materials industries or energy or industrials. And so we see that rotation is likely continuing under Trump. And so plenty of commodity and commodity equity related ideas affiliated with that.
So by materials, you mean like industrial metals, base metals, so like copper, aluminum, iron ore, steel, or is that what you're talking about? The stuff that to
Yeah, I
actually
mean, yeah,
upgrade our infrastructure, build oil pipelines, manufacture that type of stuff?
yeah, exactly. I mean, each one of these commodities has their own peculiar supply demands, balance sheet. So it's not kind of a unilateral buy everything commodity, but yeah, between domestic U.S. steel or like I said, uranium, these oil field service guys, palladium, silver for sure. We think that increasing allocation of your investment capital, a little bit away from your big tech holdings into some of this more laggard commodity related stuff and hard asset stuff, I think is the right thing to be thinking about.
Yeah, and Stanley Druckenmiller started to do that earlier this year. He started selling some of the big tech companies. I think he sold Nvidia and some of those a little bit early, but he was in them a couple years ago, so he got in early, but then he sold out early. He didn't get the top, and he's been reallocating it to gold mining stocks. Now, I'm not a huge fan of Barrick Gold and Newmont Mining, but do you think at like even though the gold price is still a little bit above 2,500, it's corrected? These gold companies, they're going to start making free cash flow. Do you think that these gold companies could have a bull market run over the next couple of years?
I'm normally more of a bullion over company holder when it comes to gold and silver. It's just the companies. They typically are underwhelming, right? They typically are underperform, and it's hard to pick them unless you're kind of in the weeds and an expert on costs and the like. And so, and we saw that with Newmont a couple weeks ago, where they had production issues and cost overruns, and so you wind up not getting kind of the leverage that you want and expect out of the gold price. I mean, if you want leverage to gold, you could buy gold calls, you could buy you know double levered ETFs. And so, but what I do think we'll wind up seeing is some consolidation and some M&A. So on the margin, I probably would say, favoring some of the smaller cap companies over the large cap companies as these large cap companies look to grow and get bigger. Is probably, I think we just saw Silvercrest mining getting taken out. And I suspect we'll get, under a more friendly, FTC environment, where mergers and acquisitions are going to be approved as opposed to contested. I think we're likely to see that take place across precious metal industry as well.
Yeah, and the mid-tier gold miners, also the large senior one, Agnico Eagle, which has two of the best gold mines in the world, they're actually having good earnings. So you have the mid-tier gold miners are doing well, but then like the market, like you were a hedge fund manager generalist, right? So if you see that Newmont Mining and Barrick Gold are having bad earnings, you're not going to necessarily want to buy a lot of gold mining stocks unless you're going to either pay for a newsletter or hire an analyst to go in there and do extra work. You're going to go buy an exchange traded fund and gold mining ETF then, but the largest holdings in there, the Newmont Minings and the Barrick Golds, they routinely miss earnings and they don't generate the free cash flow that you would think at $2,700 gold when it was only a couple months ago.
That's right. And what ends up also happening is if we have a broader commodity bull cycle, then you get oil prices and you get other commodity costs kind of moving higher. And so it threatens their margin, particularly on the energy side. So it just, it's just hard for them to get the leverage that they quote unquote should get, these big guys. But look, there's definitely some better operators than others. There's some assets that are better than others. And so if you're a specialist in that area, I could see how it makes sense. But for someone who's more in the generalist camp, you want to play the gold exposure and you're looking to get access to gold being reintroduced into the gold monetary system. It's just easier to own bullion or maybe some of the ETFs that are physical related.
Or the royalty companies like a Wheaton Precious Metals. I mean, I just bought and hold my Wheaton Precious Metal shares, and they don't do any mining. They just finance these mines. So you don't have to worry about like the labor costs going up or the energy costs going up. they get royalties and streams generating free cash flow, and their profit margins are relatively protected. And so I'm up like over 4x on my shares. All I did was just buy and hold my shares at $15 a share back in 2011 or 12, and just hold the shares and collect dividends. So I mean, like, as a long-term investor, that's pretty smart. But you're a professional money manager.
No, yeah, the royalty companies are great. I would that's definitely a different business model, for sure. Um, but yeah, we're constructive on gold, we're constructive on silver. I just prefer the commodities over the companies.
Yeah, I mean the commodities. The problem with the commodities, Craig, there's not a lot of good commodities ETFs. Like some of these ETFs, there's so many problems with them. Like they're skewed just towards oil, so there's not good diversification into some of these agricultural commodities. There's a lot of
Yeah,
issues with these commodities ETFs.
yeah, that's true. I mean, for gold, you could buy I mean, the Sprott ETFs are pretty good. They're backed by the bullion. But yeah, I hear you.
I want to thank you so much for your time today, Craig. Tell my listeners now what you're doing over at the Bear Traps Report and your new podcast with Larry McDonald.
Yeah, so the Bear Traps Report is a research based service where we are in contact with hundreds of buy side investors throughout the day, and just trying to understand what they're thinking, what they're seeing, and what they're doing. And so what we try to do is provide a lens into the buy side community and aggregate that information, synthesize it, and then redisseminate it back out to them, and out to the investment public at large. And so it's really a window into what the professionals are doing. And so what we're going to be announcing shortly is the Bear Traps Report Discord channel, where we're going to provide some insight and read-only access to those conversations and to those findings and to that research that we are doing and getting, back to a more retail-oriented community. So, you could go to our website, thebeartrapsreport.com, or you could follow me on Twitter. My handle is CES921, or the Bear Traps Report X handle, and there'll be more information about that. But we're excited about democratizing this kind of information and getting it out to a broader audience over time.
And that's what Larry has done with his book. I highly recommend his book if you haven't read it, When Markets Speak. It's an excellent book for retail investors about some of these broader market themes right now with nuclear power and big data. The next generation data centers is covered in there. I think he's warning about the commercial real estate bubble that is not over in there too.
Yep. Great.